Welcome to the market update of Bellwar Capital for the year 2023. So after this 6-month period, it's worthwhile to look at the past, what has happened, what was working pretty well, and what are the surprises on both sides, the positive and the negative side, and how we see the next 6 months coming up and how we would position ourselves over the coming month. So when you look back, what was happening? 10 stocks out of all stocks in the S&P 500 out of 500 stocks made 90% of the performance. Can you imagine? If you don't have those stocks in your portfolio, you would underperform heavily. And taking those stocks out of the performance of the indices, either the Nasdaq or the S&P or the Dow, would even come to a negative result. And we just look closer to it and take just the top 5 stocks, they made 80% of the performance. So 5 stocks made 80% of 500 stocks. So if you don't have them, what has happened to your portfolio? And what have we seen in a couple last weeks? It was window dressing. A lot of people bought into the stocks which were running well, like the Nvidias and Apples and Microsofts, because the fear of missing out was there and they wanted to show good results at the end of the second quarter and wanted to show those stocks on their portfolio list. Good is, we had the stocks before and we're selling now into the strength. That's the other side. When you look into Europe, it was a little bit different. Markets were strong, especially in Germany and in France, due to the industrial weight, and in France due to the weight to consumers, more the luxury consumers, which came to new all-time highs, like Louis Vuitton and Hermes. So from that side, Europe was much stronger on a broadly basis than the US. When you look at the SMI in Switzerland, only 5% year to date. Why is that? Very defensive index, and defensive didn't work. It was just tech which worked. So looking more into the interest rates, what has happened here? Inflation is calming down, which is very good. And we have more of a soft landing in the US. We expect the interest rates not further to rise above 5.5%. And we've seen, therefore, on the 10-year treasuries now, a little bit of an increase over the last couple of weeks from 3.2, 3.3 to 3.8. But now it's flattening out, and we believe that this might be, for the short-term future, the upper end on the yield curve. So this is very good news for the markets in general. What we've seen is that the spread in between the German bonds and the Italian treasuries has widening. So in Italy, for 10-year treasuries, you have to pay, or let's say get 3.9% to buy them. In Germany, it's only 2.1%. This is something you have to take an eye on, and this is something which the governments and the ECB will definitely look at in the second half of the year. And we expect now, going more into the outlook, we expect for the second half of 2023 rather a market which goes back more towards value stocks, which were lagging in the last couple of 6 weeks or 6 months, and which have been very good, stable, rock solid investment in 2023, but haven't been for this year. So we see a little bit, again, a sector rotation. Sector rotation is the theme of the last 6 and 12 months already, and it will be that way also for the second half of the year. But you have to really look into it and position yourself, and don't run after the stocks which have been outperforming. This is sometimes not the right decision. Look into that, what you feel comfortable with, free cash flows, fair dividends, and a very good, stable business model. That's what we're looking at. When you see at gold and the commodity space, gold was lagging, oil was also decreasing, which is very supportive for the economy and the overall inflation expectations. So we see also the second half of the year not as a very negative year, and we might have a really good year for the overall 2023. So we wish you now a nice summer, and stay tuned. And maybe you should do a little bit of a reshuffling in your portfolio over the summertime. Thank you very much.